So how does Alphabet work? Well, Alphabet makes the majority of its income from ads, which we will talk about on the 10K in just a moment. Alphabet does participate in cloud computing services with Google Drive. Their database service is extended to large corporations who need to store data at a large capacity. As such, Google has numerous competitors for multiple industries, which we will discuss in the industry analysis. Alphabet's market cap is around $1.47 trillion, making it a mega cap stock, and the company was founded in 1998. According to Alphabet's 10K, we can see where the majority of Google's revenue stems from, with the majority of Alphabet's revenue coming from ads through their Google search engine, YouTube Ads, and Google AdSense. AdSense is what powers YouTube ads, and it allows people who own websites to generate cost per click and cost per view revenue. This generates income for Alphabet as the company takes money from the advertiser who pays for their ad to be displayed, and then distributes about 25% of it to the owner of the ad space. This is how Google can profit off of their AdSense program while also having content creators benefit from their work. It's a win-win. This generated $148.951 billion in revenue for Alphabet in 2021. For cloud services, Alphabet charges for database storage, which is known as part of the Google Cloud services offered. Google Workspace is also part of this category. Google Workspace, formerly known as G Suite, is key for workers to collaborate on presentations, documents, spreadsheets, and more. Plus, it offers custom email accounts for the Workspace members, such that emails would say at your custom URL instead of at gmail.com. This is professional and it's a fantastic perk of Google Workspace. Still, Google makes the majority of its income from ads. In fact, Google has an operating loss when it comes to its cloud computing segment, despite $19.206 billion in revenue, up from $13.059 billion the year before. Alphabet has lost income from its Google Cloud services despite an increase in revenue. The loss has been lowered to $3.099 billion in 2021 compared to a $5.607 billion loss in 2020. Progress has been made in growing Google Workspace and other cloud products. However, Google still faces heavy competition from products like Office 365, and this could prevent Alphabet from gaining profitability from this segment for quite a while. Ad income supports Google's earnings with an annual income of $91.855 billion for 2021, up from $54.606 billion for 2020. The COVID-19 pandemic encouraged media growth, with more content creators and viewers joining YouTube. Overall, this significant income growth could be slowed with less advertiser spending and ongoing recession risks. In terms of acquisitions, Alphabet has been acquiring numerous companies recently that participate in cybersecurity. This includes Mandiant for $5.4 billion and Samplify for $500 million. Both were purchased in 2022. This was to help Alphabet with its Google Cloud platform and with cybersecurity becoming more and more important in today's world. These acquisitions seem like a logical place to put capital. A more notable acquisition would be the $2.1 billion acquisition of Fitbit in 2021. Finally, along with numerous other acquisitions in recent years, AR company Raxium was acquired in 2022 by Alphabet for $1 billion. This AR business seems like it is researching modern display technology to create AR glasses, and this could enhance the Google Glasses product and compete with Meta for AR glasses, as Meta already has a partnership with Ray-Ban Stories. Google appears to be staying competitive with these acquisitions, and this doesn't seem like reckless spending since Alphabet's free cash flow was around $15.32 billion for 2021. Now let's analyze the industry. According to Statista, Google has lost market share to other search engines. Bing and Yahoo have grown, with Bing proving to be the most notable competitor to Google. Bing has earned a market share of 7.61%, with Yahoo behind at around 2.85% of the market. However, Google still remains to be the most popular search engine by far, with 85.55% of the market due to its simple interface and its efficient search algorithms. And this is unlikely to change anytime soon. Google Workspace has grown against close competitors like Office 365 and Zoho. Unfortunately, Google Workspace still lags behind its peers, with about 6 million users in 2020, and Microsoft Office 365 having near 258 million users in 2021. Google Workspace has grown in users since 2019, which used to be 5 million users, and this appears to be a common theme among peers. Nonetheless, Google certainly has room to grow in the market. Google certainly has room to grow in market share as Google continues to make improvements to Google Workspace. Alphabet's price to earnings is a relatively low 20.32, not 25.16, compared to Alphabet's publicly traded competitors. Be mindful that this chart is for quarter 1 of 2022, not today's P's, so some numbers may be a bit off, but relatively similar for our purposes. Microsoft is a Google competitor in cloud-based software through Office 365 and ad businesses with Bing, and Apple is a competitor in the cell phone industry against Android. Alphabet's price to earnings is lower than Microsoft's, which is 26.51, not 32.1 currently, and lower than Apple's, which is 24.13, not 28.35, which suggests that Alphabet is undervalued relative to competitors based on its price to earnings. The Dow PE currently is 17.6, while Alphabet trades at a higher PE, and that can help suggest that there is an overvaluation of Alphabet on the stock market. The average historical price to earnings for Alphabet is near 25, which can suggest that Alphabet is trading at a low valuation relative to its earnings compared to the past. And for the price to book, Alphabet's price to book is low relative to other companies in this field. Currently, Alphabet has a price to book of 5.78, no longer 7.8, with Microsoft having a price to book of 11.61, no longer 14.22. Alphabet's price to book is high relative to its past PBs, near 5, which is concerning at this time. I also want to note that this is a high PB relative to the S&P 500 PB of 4 currently. Remember, the lower the PB, the better. According to the debt to equity, Alphabet has a low debt to equity compared to its peers. Alphabet's debt to equity appears to be near 0.4. Historically, Alphabet has a debt to equity near 0.25, which is considerably lower than its current debt to equity. The lower the debt to equity, the better. Lastly, for the return on equity, we can see that Alphabet has an ROE of 30.18%, while other companies have higher returns on equity. With Alphabet having a lower ROE than close competitors, this can help suggest that Alphabet is handling its capital less efficiently than its industry competitors. However, this is still a very decent ROE for a tech company. In terms of the intrinsic value, the company seems to offer a slight downside of 6% due to the trading price relative to its positive free cash flow over the past 10 years. After projecting the next 10 years of discounted cash flows from the past 10 years of cash flows with a perpetual growth rate, essentially the expected rate of growth of the economy, of 4%, and a discount rate of 9%, the company has a discount cash flow intrinsic value of $2,148.88 per share, relative to a recent closing price of $2,280.41 per share. Now, there are multiple ways to calculate the intrinsic value, and this is just one way, so please keep that in mind. I also want to note the company's earnings, as their free cash flow, EBIT, and net income appear to be positive and increasing, which is impressive growth for the company. This is due in part to the consistent growth in ad revenue from YouTube ads and Google ads in general. This growth may slow in the near term, as we discussed earlier. Alphabet does buy back its own stock, according to the shares outstanding appearing lower since 2018. When a company buys back its own stock, the book value per share increases, and the intrinsic value per share increases as there are less outstanding shares in the market. However, this should only happen when the stock is believed to be undervalued, because the money can otherwise be reinvested back into the company for growth, research, and acquisitions instead. In this case, Alphabet has decided that they have extra cash to repurchase stock to give back to their shareholders. In terms of dividends, Alphabet doesn't currently pay a dividend. In this case, this makes sense as they can use the extra cash to invest in their business and grow further as a company. Also, the company does return capital already to its shareholders through stock buybacks. So overall, what do we think about Alphabet? Alphabet appears to be towards the expensive end of fair value at the time of recording, in my opinion. The company has a relatively high price to book relative to its past PBs, and a relatively fair price to earnings as we discussed in the industry analysis. The intrinsic value is lower than the current trading value of the company's stock, which isn't ideal. However, other intrinsic values may suggest otherwise. Over the long term, I expect the earnings of Alphabet to grow steadily, as Alphabet has been able to grow earnings over the past decade with ad revenue growth. Alphabet offers no dividend, and they do buy back stock at this time.